Today's topic that I want to teach you about is very important, especially in today's climate of COVID-19. And that's how to evaluate if your investment or your property is over leveraged. So why do I believe this is a critical topic? Well, if you're an investor, these words should scare you. Foreclosure, personal recourse, and bankruptcy. That's not something investors like to talk about. But those things are critical terms, and you will become familiar with them if you're over leveraged. So I want to make sure that we're not. Let me back up a little bit. What is leverage? Okay? Leverage is a financing term that is the relationship between debt and equity. It's measured as a ratio. So the higher the debt, the higher the ratio. That ratio is called loan to value. Loan is the debt, the value is the equity. Let me give you an example of that. If you have a $1 million apartment asset and you borrow $1 million, it's 100% loan to value. You would be 100% leveraged. If you borrowed $700,000 to buy a $1 million apartment building, 700 divided by a million, 70% loan to value. That's called the loan to value, and that's a measurement of your leverage. That measurement is now taken as a metric into what's called a debt service coverage ratio. This is a term and a metric that financiers and bankers use to measure just how leveraged you are. Okay, so let me explain it in a little bit more detail, and then we'll shelf that and come back to it at the end of our discussion today. But the debt service coverage ratio, okay, is a formula that these are the components of. The numerator is your net operating income, and I'm sorry to go into detail, but it's necessary. And that's just how much money the property makes prior to taking out the mortgage. And then you divide that by the debt to give you that percentage. As an example, let's say that it takes you $100,000 per year to pay your debt, to pay your mortgage payment. $100,000 per year. But over the course of that year, your property makes $95,000. So I take 95 divided by 100 and get 0.95. Your debt service coverage ratio, 0.95. That means when it's less than 1, you don't have enough money making from the property to pay the debt service. That's a higher risk ratio than if you were to make $125,000 over the course of 1 year, divided by the debt service or the mortgage payment, which is $100,000, would give you a ratio of 1.25, meaning that for every dollar dollar necessary to pay the mortgage, you have $1.25 of income, less risk. Okay, those were the two ratios, and those things are used by the bank industry and the financing company to help you evaluate that point. Why is that important? Okay, leverage is a measurement of your debt, like I mentioned before. And it's the income that's necessary and available to pay off the debt service. Now, there's plenty of expenses in an apartment complex that must be paid. Your payroll, your repairs and maintenance. But those are what I coin must-pay expenses. If you're late to pay the landscaper, then he won't cut the grass next week. But the difference between must-pay and debt is secured and collateralized by the property. What does that mean? That means that if you don't pay your landscaper, he doesn't cut the grass. And he may put a lien against your property, but he has no right to it. If you don't pay your debt, your mortgage, that property is collateralized, or the property is collateralized, and they will come and get your property back through foreclosure or other judicial means. That process means foreclosure, personal recourse in the event they sell it and can't satisfy debt, they're coming after you. And sometimes because of the price of these properties, that very well may mean financial ruin or bankruptcy for you. So that's the measurement and the importance of debt, and that's a general overview on what debt and leverage is. Let's talk about the next thing, is why you want to leverage a property. Okay, now that we've talked about what is leverage, let's talk about why you would even want to leverage a property in the first place. Well, one thing leveraging does when you secure debt to buy something, it requires raising less amounts of money. And you can buy larger properties. So there's certainly an advantage of doing that. Also, when you leverage a property, it increases the return. Okay, we talked about earlier the loan to value. So let's go over a couple of examples so that you really understand leverage, and then you'll understand the next thing we talk about is how to take advantage of that. So for example, I mentioned earlier, if you have a $1 million project and you get $100 million of debt, it's 100% leveraged. I take that property, I own it for 1 year, it produces $100,000 of distributions or cash. So I take that $100,000 of cash back to the investors, and I divide that by the amount of money I put down on the property. I put down 0, so $100,000 divided by 0 is an infinite return. That's the best possible leverage because it's the highest possible return. That doesn't happen very often because it's a risk to the bank or the debt. Let's go to the other side of that, a more reasonable leverage position. Let's say that you have to take an 80% loan to value. What does that mean? You're going to get 80% of the value of that project, $1 million, 80% is $800,000. So now as an investor, I'm going to have to bring in $200,000 to buy the property. I just mentioned over the course of 1 year, that property produces $100,000 of cash. I divide $100,000 by my money I put in, which is $200,000. 100 divided by 200 is a 50% return on investment. So there's a balance there, as you can see. So why would an investor want to leverage a property? Obviously, I don't have to bring as much money, and it drives the investor return up. But there's a fine line. One hand, the bank, which is generally the debt, is incurring more risk as the property leverage goes up. The bank wants to encourage you to be responsible and leverage it with responsible leverage. On the other hand, there's the investor that wants to capture the maximum amount of equity, increase the returns as high as possible, and not intentionally, but oftentimes that results in an over-leveraged position. So you as an investor, either active or passive, have to walk that fine line between using the right amount of leverage and balancing risk versus return. But that's why you want to leverage a property. Okay, so far we've talked about what is leverage. We talked about why you want to leverage. And now I want to bring it back into the current impact of leverage in today's real estate market. Well, I'm an investor in Texas, and I know that Texas is similar to the other states. There's been a tremendous interest in apartment investing and in real estate. That has driven a lot of money into the market, and as a result, it's driven the prices of these projects higher and higher and higher and higher. So to get a project and to purchase it, now oftentimes being very aggressive with pricing. Often the investors are going in with overpaying or paying with very little operational cash flow. They're using very aggressive underwriting. What does underwriting mean? It's just basically an evaluation of what the property is currently worth and what they will be able to operate it for income and expenses. They're coming in with very aggressive business plans. What would be an example? Let's say I buy a dysfunctional property that maybe has some occupancy issues, or maybe it has some property physical problems that need to be solved. And I come in there with a very aggressive business plan. Something like, I'm going to come in, I'm going to make these improvements, and I'm going to raise rents by 5 or 10 or 15%. That would be aggressive. I have aggressive rent growth. And also maybe I've looked at it as an aggressive underwriting and said, hey, I know that right now the property is being operated for $5,000 per unit, but I think I can operate it at $4,700 per unit. That would be an example of how I have taken a more aggressive position and thinned down my financial model. Or maybe I've just put less money into the cash reserves. In other words, I have a much smaller cash cushion because I've got to take that cash that I would be holding in reserve and I've put it toward a higher purchase price because of the current market conditions. Okay, so now the current impact is higher prices, more aggressive evaluations, and then I'm going to sell you as an investor or sell the bank as a debt borrower, okay, my financial plan, or often called the pro forma, the performance. But in doing that, I've taken some pretty aggressive, already said, assumptions, and I really haven't stress tested that property at the right point. What do I mean by stress testing it? Okay, so let's say that I build a financial model that says we're going to buy this 100 unit complex and we're going to run it, or we're going to make improvements so that we consistently have 94 of the 100 units occupied, and those renters are paying their rents on time, they're paying all the revenue sources, and so I'm expecting to get 94 or 92% of the units rented out. That's a pretty safe assumption in normal times. However, to stress test this and determine if I am over leveraged, then I need to plan for or anticipate something less than ideal. Ideal is 94%. In this case, I want to stress test that and say, what if I only get 85% instead of 94%? How will the property operate? So that's a stress test that I can help determine if this is going to be over leveraged. Another stress test that I recommend you ask about or that you perform yourself is expenses. We talked about previously, maybe the current owner is operating this at $5,000 per unit. You think you can operate it at $4,700. There may be justification for that. But it's also important that you stress it and say, what if I miss that assumption? Let me go from 5,000. What would it operate at 5,200, 5,300? That's another stress test that I recommend. And then the final one, which oftentimes gets overlooked, is I come in with a very aggressive business plan. I'm going to make these improvements. I'm going to repaint it. I'm going to get a new type of tenant that can afford higher rents. Therefore, in year one, I'm expecting a 4% growth in the rent. In other words, today's rents are $1,000, but when I take it over, I'm going to have a 4% rent growth, $1,040. The year after that, I'm going to have a 4% rent growth. And those numbers are part of my model that helps me evaluate what I mentioned before, my debt service coverage ratio in year 2, 3, and 4 are based on that revenue growth stream that may or may not be accurate, and it may or may not be stressed so that if that number flatlines or that number changes, I may be over leveraged. Okay, So sorry about that long-winded discussion of current impact, but let me bring that right now home to where we are. Okay, we're about to turn into March 2020, and the COVID-19 virus, or the COVID-19 virus and business impact is about to debut. We're already projecting a 20% unemployment nationally. That's going to have impact on our tenants' ability to pay rent, and it's going to decrease our revenue. The industry currently doesn't know exactly what that will look like, but they are projecting a 30% revenue decline. Plus, they've mandated state laws so that evictions, late fees, and things are governmentally regulated. So we're not going to be able to take the standard normal operating practices. What does all of this mean in the current impact of today's apartment investing? That means you have to be very careful about leveraging and very wise about how you do that. But COVID-19 is going to be an impact to the apartment industry, and hopefully we can weather that storm and come out stronger and in a better investment position. Okay, now we've learned what is leveraged. We explained why you would even want to leverage. We explained how to determine the impact of the current situation on a leveraged property. Now it's important to ask, is your investment or is your project over leveraged? What I mentioned in the previous section was really more of an upfront due diligence type of situation. More than likely, you find yourself involved in an apartment investment where you've already got a stabilized asset. So the things I'm recommending now to determine if you're over leveraged are really just a look at where your current financial situation is. So the things I recommend is you need to very carefully evaluate your budget and verify each expense line is accurate, determine if that's required or necessary, along with verifying each revenue line. So each source of revenue has to be evaluated to determine the durability of that, and then also determine if that is indeed an accurate number. So I'm going to take my budget and I'm going to ask, what expenses do I have, and can any of these be a delayed payment or can they be cut? And then I'm going to look at my revenue line and I'm going to say, is this a durable stream of income or is this something that may be declining? I'm going to take those two numbers, I'm going to go through revenue minus expenses, and then I'm going to find out how much cash does that produce so that I can pay my debt, which is my debt coverage. And then I'm going to take that number, whatever that cash flow may be, and I'm going to begin to whittle it away. In other words, I'm going to do that and I'm going to reduce revenue by 10%. If I lost 10% of revenue, how would I still be able to service debt? If I lost 20% of revenue, would I be able to service debt? 30%, and so on. At some point, you will get into a negative cash flow percentage. And that's the point that gives you the margin to say, ooh, we're okay for a while, or whoa, we really can't sustain much revenue loss without going negative cash flow. So the procedures and the suggestion to determine if you're currently over leveraged in your investment or in your property is what I recommended. Okay, now that we've determined the question how to evaluate if you're over leveraged, let's talk about what can be done if you feel like you are over leveraged. Well, these are the procedures that I'm following right now, is immediately initiate emergency cash procedures. In other words, try to build as big of a cash cushion as you possibly can to endure what is laying in front of us or what's coming in front of us. The second thing is do a line-by-line audit of your budget and look for areas that can be cut or that can be delayed or that can be postponed. The third thing is suspend any distributions of cash and put that cash into reserve so that you can endure potentially loss in revenues. And then the last thing is talk to your debt servicer or your banker, because he understands what's going on with the current national health crisis and more than likely willing to work with you to help you mitigate that period where you're going to have to endure reduced revenue. But those are some of the things I'm doing right now, trying to be proactive and trying to be in front of this current health crisis that potentially is going to cause an economic crisis. So let's summarize what we talked about today. We talked about what is leverage, why it's important, how leverage is impacted by the current COVID-19 situation and economic environment. We talked about methods to determine if your property or your investment is over-leveraged, and then what can be done if it is over-leveraged. I hope that was helpful to you to understand what's going on in today's market so that you can put your position or put your capital in the right spots. Other action steps I would highly encourage you to take are make sure you like and follow us on Facebook page, Pilot Legacy Private Equity Group. Also want you to encourage you to join our private Facebook group, Be a Better Millionaire. And we also have all these videos on YouTube. Subscribe to our YouTube channel, Pilot Legacy Private Equity Group. Until I see you again, I want to challenge you to think like a millionaire, to talk like a millionaire, to act like a millionaire, so that you can become a better millionaire. Thanks.